Hello once again, and welcome to my third video on stock market gambling. Uh, I apologize about the abrupt stop in my last video. I just saved it in the middle of recording it accidentally, and instead of starting over, I just decided to leave it as it was and start a third video. I'm sure there's probably a way to splice two videos together, but unfortunately I don't know how to do it, so you'll just have to bear with me. So without further delay, let me try to explain the various market orders, and we'll start with the buy orders. And as I said before, first you have to find a stock. So if it's not in your watch list already, use the magnifying glass and type in the call letters of the stock that you're looking for, and it'll come up. Here's the stock that I decided to use as my example. Incidentally, the call letters for this stock are EARS. Notice right here that there is a button that says buy. If I owned the stock, there would be a button that says buy and a button that says sell. But since I don't own the stock and Robinhood does not allow you to sell short, all I can do is buy. So that's the only button that's up there right now. So once you click buy, the screen will come up to make a market buy of that stock. Now if you click on order types right here, there are 4 different order types that come up. However, market buy is the default, so it's the one that comes up just at first when you just click buy. Market buy is the simplest of the buy orders, and it simply works like this. All you do is you put the number of shares that you want to buy in the right here. So this is what it would look like if you put 1 share in. So what that means is that you're buying 1 share of EARS at the market price. Now that does not necessarily mean that it's going to be $2.08. It could be more. It could be less, but it's more likely that it'll be more. The reason for this is somebody always needs to take the other side of your trade. And a market buy is just telling the software, buy at the first available opportunity. For the most part, I do not recommend making this sort of order. The reason is you might have a gap up and all of a sudden pay a lot more for your stock than you anticipated. What a gap up is a sudden and drastic move up in the price of a stock. For example, this stock that's priced at $2.08, a few seconds later it could all of a sudden be $2.50. That's a gap up. And very frankly, you might not want to pay $2.50 for the stock. That might be too much. You see, what a market order does is it just buys a stock automatically at market price at the next available opportunity, whatever it is, regardless of price. So you have no protection against a stock gapping up and then you end up paying way more than you anticipated. So to protect myself from that happening, I almost always use a limit order to buy a stock. To make a limit buy, you'll have to click on the order types. So click here on order types, and this screen here will come up. So instead of making a market order, click on limit. How a limit order works is you specify the maximum amount that you're willing to pay for a stock. And although this is normally used to buy a stock when it falls to a certain level, in other words, say a stock's at $21 and you want to buy it for $20, so you put in a limit order for $20, and then when and if the stock drops to $20, you'll buy it. However, it can also be used to buy a stock immediately, but to protect yourself against a gap up. So in the last example, what I would do is the stock was $2.08. So what I might do is put in a limit price of, say, $2.10. Then I will buy the stock as long as it's $2.10 or lower, and thus protecting myself from a big gap up and paying way more for the stock than I anticipated. So after you put in your limit price of, like in the last example, say you put in $2.10, then this screen here will come up showing the time in force. Basically, that just what you should do is just click on the top one. That just means that it's going to be good until the close of the current trading day or the next trading day. So that will bring up this screen, and you're ready to make your buy. As you swipe up to trade, so you just put your finger on your phone and swipe it up, and as long as you can still buy the stock for $2.10 or less, your order will execute. But like I said, if there was a gap up and the stock went up above $2.10 while you were trying to make the trade, then your order won't execute, and it will still wait to see if the stock drops to $2.10, at which point your buy order will go through. The third example of the type of buy order that you can make is the stop loss buy. This is also a type of order that I do not recommend making, and I'll explain why. What the stop loss buy does is you put in one price, and the price is supposed to be above what the current price is. So it's used to buy a stock that's going up in value. This is a common technique used and is not where the problem lies with this particular order. The problem with the stop loss buy is it has no limit to the price that you're willing to pay. So say, for example, a stock was currently at $20 and you put a stop loss buy to buy it if it reaches $21 or higher. What would happen is, even if it gapped up from, say, $20 all the way up to $25, you would still buy the stock because it has gone above $21. That is the indicator that changes your order to a market buy, at which case you will just buy it at the next opportunity. So the stock value goes up above $21, you buy it at the next opportunity, you have no protection against paying way more than you anticipate. Now, the way you can protect yourself against this is to do something similar, but it's a stop limit buy as opposed to a stop loss buy. With the stop limit buy, you still put in a stop price, which is the price that you want the stock to go up to in order to make the buy, but you have a limit on that amount. So say in the previous example, the current price was $2.08, and you put in $2.10 as your stop limit number. That's just safe. That's just a precaution to make sure that the stock is on its way up when you buy. That way, if a stock starts plummeting, you don't buy it and you get to wait to see the outcome before you buy. So for example, you put in a stop limit buy at $2.10 when the price is $2.08. Well, it falls, and it falls more, and it falls more, and it falls more. You didn't make the purchase, so therefore you can wait and see the outcome before making a buy. If, for example, you'd made a market order in that circumstance and bought it at $2.08, then you're stuck with the stock at $2.08 before it falls to, say, it just fell to $1.80. If you put in the limit buy, you would not have purchased that stock, whereas you put in the market order, you purchased it at $2.80 right before it fell to $1.80, just as an example. So the difference between a stop loss buy and a stop limit buy is that you protect yourself on the high side as well from a gap up, making it so that you pay an unexpected amount for the stock. For example, say the stock price was $2.08 as the previous example. What I might do is I put in a stop price of $2.10 at this screen here. A stop price of $2.10 means, okay, once the stock has reached $2.10, that puts the order into action. However, when you make a stop limit order, a second screen shows up giving you the maximum amount you're willing to pay for the stock. So for example here, I put in $2.20. What that means is that as soon as the stock hit $2.10, that would initiate the order, but it would not execute if I had to pay more than $2.20. So that protects me against a gap up, as I discussed previously. I definitely recommend you protecting yourself against the unexpected as often as possible. So therefore, I recommend making stop limit buys, and I do not recommend making stop loss buys. So always put a limit on your buy to protect yourself against a sudden gap up. And when using the stop limit buy, I recommend in general you should always put your stop price a little bit above the current trading price. That way, if the stock happens to start plummeting right as you're about to make your purchase, you will be unaffected and you'll just be able to watch as the stock price falls before making your purchase. For example, say the market price of the stock that you were about to buy was $2.08, like in the previous example. So you put in a stop price of $2.10 and swipe your order. Well, by the time your order gets placed, you notice that the price has now dropped to $2.01. So you cancel your order and then you put in another order. This time putting your stop price at, say, $2.04. You put in that order. Then while that happens, the stock price drops again to $1.97. So now you cancel your order again and put in a new stop price of $2, just above $1.97, and it drops again, and this keeps happening. Eventually what's going to happen is you'll get a good price right before the stock goes up a little bit and makes a little rebound. So say, for example, you do this procedure and it goes all the way down to $1.80. So now you put in your stop price of $1.82, the price of the stock goes back up, and voila, you got the stock at a much lower price than you would have had you just made a market order. So now you should be thinking, okay, well, Todd, how do I cancel an order then? That's very important. Well, you're right. It is very important that you know how to cancel an order. So I'm going to show you how to right now. To start with, from the menu page, click on History right here. That will bring up the history of all of your transactions with the most recent transaction on top. As you can see, I have a queued order to do a limit buy for EARS. The reason it's queued is because this order was made on a Sunday during off-market hours. It will be placed as soon as the market opens on Monday morning. But actually, this order will not take place on Monday morning because we're going to cancel it, and I'm going to show you how right now. So the first thing you do to cancel an order is simply click on the queued order, and this screen here will show up, which is the order page. You will need to scroll to the bottom of the order page to right here where you see Cancel Order. Just click on that and your order will be canceled. Once you've canceled that order, then you can initiate a new buy order with new parameters. See you in the next video where I will be going over the various sell orders that are supported by Robinhood.